Ladies and gentlemen, good day and welcome to GMR Airports Limited, formerly GMR Airports Infrastructure Limited, conference call to discuss Q2 and FY2025 results. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. We have with us today Mr. Saurabh Chawla, Executive Director, Finance and Strategy. Before we begin, I would like to state that some of the statements made in today's discussion may be forward-looking in nature and may involve risks and uncertainties. Also, recording or transcribing of this call without prior permission of the management is strictly prohibited. I now hand the conference over to Mr. Saurabh Chawla for the opening remarks. Thank you, and over to you, sir.
Thank you, and good afternoon, everyone. I welcome our shareholders, analysts, and other stakeholders to our Q2 fiscal 25 earnings call. Q2 has set the right momentum going into the festive quarter, which is the best quarter for travel. According to Money Control, data from Atlas, a visa platform, showed that there has been considerable surge in visa applications from Indian travelers during this festive season. For instance, visa requests for Diwali and Durga Puja have increased up to about 18% as NRIs and international visitors from Europe, US, Southeast Asia have planned trips to India. Similarly, the annual Oktoberfest in Germany, which was held between September 21st and October 6th this year, reported an 18% rise in visa applications from India. Besides festivals, music concerts and sporting events have also driven travel demand amongst Indians, especially for overseas destinations, leading to a rise in visa applications. The Hong Kong Tourism Board has said that Indian travelers are amongst the top spenders in Hong Kong, with an average expenditure of Hong Kong dollars 9,000 per person. Additionally, the average length of stay for Indian visitors has increased from 3 days in 2018 to 4.5 days in 2024. The Special Administrative Region of China is setting ambitious goals to double the number of Indian visitors this year by organizing a series of festivals and events to attract them. As such, the type of focus on Indian travelers is tremendous, and this is just a small example to demonstrate that. And of course, the first and the last leg of the travel happens at the airports. Hence, we are very excited and optimistic of the opportunity space and the prospects of GMR airports. In fact, Delhi's Indira Gandhi International Airport climbed to 24th position amongst the world's best connected airports, improving from 25th spot in 2023, reflecting its growing importance as a global aviation hub. The Travel Data Official Airline Guide OAG's report stated. Delhi Airport was the only Indian airport in the top 25 list. I'm also happy to share that GMR Airports was the sole Indian airport developer to be named in the world's most trusted companies in Newsweek's 2024 survey and achieved a 5th place globally in the transport, logistics, and packaging category. This echoes our strong focus on governance as well as stakeholder relationships. Our Hyderabad Airport has also won India Travel Awards for Best Airport for the 3rd consecutive year. On that note, let me delve into our Q2 performance. Momentum in total income continued, with Q2 at INR 26 billion, up 20% year-on-year, driven by traffic and tariff growth, translating into EBITDA growth of 17% year-on-year to 9.6 billion rupees. EBITDA margin for the quarter was at 49% versus 52% in Q2 in fiscal year 24. higher finance costs and depreciation arising post-completion of expansion of Delhi and Hyderabad airports led to GMR Airports reporting a loss from continuing operations of INR 4.3 billion. These movements are expected in any infrastructure company post a heavy capex round. However, we are encouraged to see that we are close to the cash break-even on a consolidated basis, and given the expected traffic increase and traffic revision due at Delhi Airport, our position will only improve from here in the coming quarters and years. Consolidated net debt, excluding the foreign currency bonds of INR 24.3 billion, stood at INR 287 billion, increasing by INR 7 billion versus quarter 1 fiscal 25. This was mainly driven by a combination of borrowings raised at Bhogapuram, which is a greenfield project being undertaken, and payment of balanced capital expenditures at Delhi. On the operational front, we continue to see growth in traffic. That is 8.8% year-on-year growth in quarter 2, reaching about 31.5 million passengers. Domestic tax traffic grew 7% year-on-year, and international traffic grew at 12% year-on-year. There was a marginal dip in traffic versus the last quarter, driven by seasonality. International passenger traffic share for this quarter was at 24%. Regarding specific airports, during the quarter 2, passenger traffic at Delhi rose 8% year-on-year to 19 million passengers. At Hyderabad, traffic was 14% year-on-year to about 6.9 million passengers. Both these airports handled the highest number of half-yearly passengers ever in the first half of fiscal 25. Goa traffic rose 16% year-on-year to 1.04 million passengers. Total income at Delhi Airport rose 10% year-on-year to about 13.8 billion rupees, driven by traffic growth, with EBITDA almost unchanged year-on-year to 4 billion rupees. A couple of points to highlight here. One is that our employee benefit expenses for the quarter increased post the disbursement of annual increments. And also, the DIAL JVs, especially duty-free, declared dividend on which revenue share is payable. So while income from associates gets accounted below EBITDA, but the revenue share is captured above EBITDA when dividend is declared. At Hyderabad, total income was about 5.8 billion rupees, up 15% year-on-year, with growth driven by both traffic and slight increase in aero tariffs for the fiscal year 25. EBITDA was up 9% year-on-year to 3.7 billion rupees. MOPA, which is Goa Airport, reported total income of 978 million rupees, an increase of 134% year-on-year on a lower base, strong traffic growth, and new tariffs applicable from January 24. The airport continues to report positive EBITDA in its initial years of operation, with quarter 2 at 406 million rupees. Notable achievements during the quarter are as follows. We continue to consolidate our stakes within our airports. GMR Airports entered into a share purchase agreement with Fraport Frankfurt Airport Services towards the acquisition by GMR Airports from Fraport of their minority 10% equity stake in Delhi International Airport. Post the proposed acquisition, GMR Airport's stake in Delhi Airport will increase to 74%. Progress on foraying into airport adjacencies business continues. GMR Airports entered into a license agreement with Delhi Airport on 21st August 24 after emerging as the selected bidder to develop, operate, manage and maintain duty-free outlets at Delhi Airport. GMR Airports will take over the operations of Delhi duty-free from 28 July 2025. As all the adjacency businesses start generating cash at the GMR airport level, along with dividends from airports, we are very confident that the corporate debt of GMR airports would start to slide down over the next few years. GMR Nagpur International Airport, a wholly owned subsidiary of GMR Airports, signed a concession agreement with Mihan India Limited on 8th October towards the upgrade, development and operation of Nagpur. The process to take over the airport is underway. Honorable Prime Minister Shri Narendra Modi graced the groundbreaking ceremony for the upgrade and modernization of the airport on 9th October 2024. I'm also happy to announce that the operations at Delhi's new Terminal 1 started from 17th August. This will significantly boost our capacity, easing pressure on Terminal 2 and Terminal 3. Post this expansion, capacity of Delhi Airport is now 100 million passengers. At Hyderabad also, the expansion works are complete and commissioned, taking the airport capacity to 34 million from 12 million passengers. Earlier this week, GMR Promoter Group executed an agreement with a wholly owned subsidiary of Abu Dhabi Investment Authority, or ADIA, on 23rd October 24, securing 63 billion rupees in structured debt instruments with a tenure of up to 8 years and carrying no cash coupon. Basically, it's 100% PIK. Proceeds from this transaction will be used to refinance all loan against shares of GMR Promoter Group, thereby consolidating multiple lenders into a single source of very long-term capital. This will lead to a significant reduction of pledge of GMR Promoter shareholding in GMR Airports, along with mitigating both refinancing and settlement risk. As you all know, we completed the merger of erstwhile Airports Holding Company with the ListCo in July 24. Subsequently, the name of the ListCo has also now been amended to GMR Airports Limited. I would also like to highlight and clarify a couple of regulatory updates in the past few weeks. The first one being Supreme Court order of 18th October, where it held that the appeals filed by Airports Economic Regulatory Authority, which is AERA, against orders of Telecom Disputes, Settlements and Appellate Tribunals, which is TDSAT, are maintainable. We would like to again clarify a misunderstanding created by certain media groups on this order. The judgment has nothing to do with the decision-making power of AERA over tariffs for non-aeronautical services. It simply maintains AERA's rights to contest the TDSAT judgments received by airport operators or service providers in the Supreme Court. The cases/litigations that have been filed by AERA will proceed for hearing based on merits. The second order, which represents a significant upside to dial EBITDA when implemented, came from Delhi High Court, where it dismissed the appeal by Airport Authority of India against the Arbitral Tribunal's award. The award pertained to definition of revenue for computation of annual fee, that is the revenue share, payable by Delhi Airport to Airport Authority of India. Specifically, in calculating revenue, certain items have been allowed to be excluded. Details are in the press release and presentation. Also, Delhi Airport is entitled to refund of excess annual fee paid from June 2015 basis this calculation of revenue. As of September, at Bhogapuram, 42% physical progress is complete, while at Mopa, 99% expansion is complete, and we expect commissioning within Q3 of fiscal 25 at Goa. At Crete, almost 40% progress has been achieved as of September. At GMR, as we connect the world, We recognize our responsibility to reduce carbon emissions and environmental impact, foster inclusive, diverse, and safe airport communities, and govern with transparency, accountability, and integrity. CSR spend for quarter 2 totaled INR 40 million, with total beneficiaries of over 20,000 people. Delhi Airport became the first airport in Asia to achieve net zero carbon emission status, surpassing its original target to achieve this by 2030. It has earned the esteemed Level 5 certification from Airport Council International's Airport Carbon Accreditation Program. This underscores a 90% reduction in Scope 1 and 2 carbon emissions, with remaining offset through approved methods. Our Hyderabad Airport was conferred with 2 titles at the 25th Annual Award Ceremony for Excellence in Energy Management, organized by Confederation of Indian Industry. The first award, National Energy Leader, marks airport's 6th consecutive win, while the second award, Excellent Energy Efficient Unit, was secured for the 8th consecutive year. The presentation with all the financial numbers are already available with you. If not, you can download it from our IR section of our website. We are available to respond to your questions on this call and offline after the call. Now, I would like to open the forum for queries that will be addressed by my colleagues from the corporate and business teams. Thank you so much.
Thank you. Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask questions may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask questions, please press star and 1. The first question is from Mohit Kumar from ICICI Securities. Please go ahead. Mohit Kumar from ICICI Securities, you may go ahead with the question. There seems to be no response from the line of Mohit Kumar. We'll move to the next question. Next question is from Prateek Kumar from Jefferies. Please go ahead.
Yeah, good afternoon, sir. My first question is on Hyderabad Airport. In this particular quarter, we have seen like non-air revenues have been like sort of flattish on a year-on-year basis at Hyderabad, despite like sort of commissioning new capacity, etc. And much higher volume numbers. So why that would be the case? That is the first question.
Prateek, can you please again ask the question a little slowly because there's a little bit of disturbance. Just ask slowly. We have not understood your question, please.
The non-aero revenues at Hyderabad Airport are flattish at during this quarter on an year-on-year and quarter-on-quarter basis at 148 crores. So any specific reason, despite the growth in volumes, why the overall non-aero revenues are like slower growth in this quarter?
Sure. So Rajesh, you want to take this question, please?
Yes, Saurabh. Am I audible?
Yeah, you're audible.
Okay. So, Prateek, in case of Hyderabad, there are some stores which are still under renovation, and we are redoing some of the stores, both on the retail side as well as on the F&B side. So, and those stores will be up and running in the next 2 quarters. So, as we go along, you will see a further growth in the spend per pax. And secondly, when you see on this quarter versus last quarter, it will be primarily because of the seasonality impact primarily on the duty-free business.
No, I was just comparing it to last year's number, which is exactly same. But your volumes are much higher year-on-year, but your non-air revenues are actually same year-on-year. So Yeah, that's positive.
Yeah. As I mentioned, Pratik, there are some stores, because we just expanded our capacity, and there are new stores which are getting added. The older stores are undergoing renovation, and we are redoing those stores. So those are being kind of innovated in a phased manner, and we'll see the full impact of the total growth coming in the next subsequent 2 quarters.
Okay. Second question is on, we have now completed the expansion at both Delhi and Hyderabad. Are there any startup costs, etc., which is part of P&L, which is also impacting margins at current, like maybe in second quarter and maybe third quarter also, because they just completed and maybe it will take some time to ramp up and they'll get absorbed as the volumes sort of pick up?
Pratik, you are right. I'll ask GRK Garu to answer this, but you are alluding to the right aspect. Yeah.
No, as far as the costs are concerned, we have almost accounted for. The manpower has already been ramped up, and it has already been accounted for in the second quarter. There will be a slight increase in manpower, otherwise more or less everything has been now in place.
So not much of a delta, Pratik, on increase on the costs. You're absolutely right. In quarter 2, there would be ramp-up costs that would have been taken into account in the both expanded airports of Delhi and Hyderabad.
This will get counted only in the employee cost or somewhere else also in any other line item?
No, employee cost, whatever the increase in the employee number has already been accounted. There will be a slight increase in the maintenance cost because now we are awarding the contracts, expanded terminals. There will be slight increase.
Okay. Third and last question is on interest expense. So that seems a bit higher at Delhi and the ConCall level this quarter. Any one-off in that number, if you can help us?
The interest cost in case of the Delhi is basically the increase in quarter-on-quarter is because we have completed the refinancing of 2,500 crores. In that context, the old hedges have been cancelled, and because of that, 82 crore rupees has been accounted as a one-time in the interest cost.
The benefit of this refinancing, Pratik, will flow over the next many years because there was a substantial delta between the existing bonds that were there on the books of DIAL versus the new financing that we have in place.
The existing bonds were carrying almost at 11.5% rate of interest, and we have refinanced with the 9.5% rate of interest. So you'll see the reduction in the interest cost going forward in the quarter-on-quarter.
Sure. Thank you, sir. I'll get back to you.
Thank you. The next question is from Karthik Chellappa from Indus Capital Advisors. Please go ahead.
Yeah, thank you for the opportunity, sir. I have
Karthik, we can barely hear you. If you're on a hands-free, request you to use the handset.
Sure. Is this any better? Am I audible right now?
Yeah, slightly better, Karthik. Please go ahead.
Okay, I'll try to speak louder as well. So my first question is, if I were to look at our cash flow statement for the first half today, at an operating cash flow, we are almost like down about 40-45% year on year, purely on operating cash flow. What would be the reason for that?
So basically the capitalization of the entire assets and the interest cost hitting the P&L account. Earlier it was taking into the CWIP, and we were doing it interest during construction, which has been capitalized as of 31st March 2024. Now it started hitting the P&L account.
So this is something that should continue for the rest of the year, at least this year, right? Because the capitalization was higher this year relative to last year. Would that be a fair understanding?
Karthik, I would actually allude to a little different thought. It has already hit Now the impact will only get mitigated as the traffic continues to grow.
And tariff.
And the tariff and the new tariff as and when it comes. So this is a very short-term phenomena as far as this fiscal year is concerned.
Got it. Okay. My second question, sir, is if I were to look at Delhi Airport and Hyderabad Airport's P&L, I mean, in Delhi Airport, the revenue growth is still pretty decent, but the EBITDA, absolute EBITDA is almost flat. Whereas in Hyderabad, again, the revenue growth is healthy, but the EBITDA is still growing lower than our revenue growth. Now, you alluded to some factors like, renovation of some stores on the non-aero side in Hyderabad and some maintenance expenditure or so. I'm just curious to see at what point of time do you think we will start to get this non-linear growth at both these airports where the EBITDA growth will be faster than revenue? At what point do you think we can start to see that?
So you'll have to wait for a few quarters for that to happen, because as businesses migrate from being either in the JVs or in the subsidiaries into the main entity, the EBITDA growth will still remain, I would say, range bound. But as those businesses stabilize and the revenues start to getting fully captured, for example, in Delhi, the duty free will only happen from next year, right? In Hyderabad, while the duty free is already being captured in the main entity, but it is still kind of treated as a pass-through. So it is still work in progress. I would say you should look at the absolute numbers that will emanate over there over the next few quarters, and not look at the initial gyrations that are happening as these businesses migrate.
Got it. My last question, sir, is if I were to look at the GAL's profitability statement, and if I take that whole EBITDA, which you have disclosed, which is 9618 million for this quarter, if I were to deduct, the Delhi Airport EBITDA, Hyderabad Airport, and then Goa, and if I were to do a year-on-year comparison, the EBITDA, which is not attributable to these three airports, has actually grown significantly year on year. What would be the income streams or drivers of this EBITDA? And should we expect that this EBITDA will continue to grow faster than the EBITDA at the three airports?
Okay.
Karthik, your understanding is perfectly right. The growth in EBITDA is more because one is the GAL standalone. Plus, if you look at the subs, what we have at the Hyderabad or the Delhi airports, those JVs, especially the MRO is doing very good. So this EBITDA is contributed by the GAL standalone and these subs at the airports. And as we move forward, these subs are performing very well, and hence the expansion in EBITDA moving forward will be, visibility will be more.
Especially the MRO has done exceptionally well this quarter. And also, the GMR airports also started operating the car park at Hyderabad Airport. All those things have added the additional EBITDA.
Which means we can expect that going forward, the GAL EBITDA growth will probably be even faster than the EBITDA growth at the three airports because these income streams are growing faster, right? That would be a reasonable conclusion.
To some extent.
Correct, Karthik.
Okay. I do have a few follow-up, but I'll probably come back in the queue. Thank you very much, sir, and wish you and the team all the very best and wish the team a happy Diwali.
Happy Diwali to you also, Karthik. Thank you so much.
Thank you. The next question is from Jainam Jain from ICICI Securities. Please go ahead.
Good afternoon, management. Congratulations on the results. So my first question is, why are we seeing the higher interest cost, that is 140 crores higher compared to the previous quarter, even though the debt level has not increased?
The same interest cost. Because the premium which we have paid on the cancellation of the hedges has been accounted for in Delhi to the extent of about 82 crore rupees. and there is additional FCCB to the extent about 30 crore rupees. 40 crore. And total about 120 crore rupees additional interest has come.
Okay. And sir, when do we see the Bhogapuram and Crete Airport capex working getting completed?
Bhogapuram will be completed by only 2026 July. That is was the target, though the time is available up to December. Delhi is already been completed. Crete is up to 2027 February.
Okay, sir. Right. Thank you.
Thank you. Next question is from Mohit Kumar from ICICI Securities. Please go ahead.
Yeah. Good afternoon, sir. So first question is on the tariff order for Delhi. I think consultation paper is yet to be issued. What is your expectation of the final tariff order for Delhi Airport? Some timelines.
The application has already been filed very recently. The entire ERA, along with the chairman members, have visited the airport and visited all the facilities. SBI Caps has been provided with all the explanations, whatever they've asked. Now, the data submission is completed. They are in the process of drafting the consultation paper. We are expecting that it should be hit any time by end of November. That's what we are hoping for.
Expect the consultation paper to be out by end of November or December?
By end of November.
But that will be your interim tariff.
No, it is basically the consultation paper will be out.
Okay, yeah.
After the stakeholder consultation, once it is completed, we are expecting the final tariff order in the mid of February,
Correct.
hopefully, and will be implemented by 1st April.
Correct. From a retrospective.
Understood. The second question on the Delhi duty free, I think you won the contract. That's what you alluded, right? So my question is, what was the bidding parameter, and what is the revenues for the Delhi duty free in H1 and profit? Is it possible to share?
H1.
So, Rajesh, you want to take it for Delhi duty free? What were the bidding parameters and what was the profitability last year and in H1? I think those are the two questions.
Yeah.
Correct me if I'm wrong.
Revenue and profit, yeah, both.
Revenue and profit, yeah.
Yeah. So now I'll take up the first question, which is the bidding criteria. So this was basically the highest revenue share. That was the criteria, and there were certain technical qualification requirements, and plus the financial criteria was the highest revenue share. And GMR Airports got it on a competitive basis, and which is the revenue share is again competitive to what currently being paid by Delhi Duty Free to Delhi Airport.
Understood.
On the profitability and revenue, maybe GRK Garu, if you can take up.
Yeah.
As far as the Delhi duty free is concerned, in the first half, it has achieved a turnover of almost about 1,050 crore rupees with a PAT about 90 crores. And the last year, it was also about 1,000 crore rupees turnover, but the PAT was a little higher because last year, in the corresponding period, they have ITC input tax credit was available. Now it has been withdrawn. Because of that, the profit has come down.
So the question was for the entire year, that's fiscal, FY24.
FY24, Delhi duty free has closed with a turnover of 2,050 crores, with a PAT about 200 crores.
Understood, sir. Understood. My last question, sir, of course, you mentioned that GMR Enterprises entered in structured debt transaction with ADIA, right? How does it help us? In the sense at the company level, yeah. Because given that I'm asking this question because our interest cost of 1,000 crores is still very high on it, 30,000 crore debt, right? Of course, I do understand that there is a part of it is premium or something which you paid for refinancing, but still that number is still very high. Is there any way we can reduce to, maybe something, can you explain a 3,000 crore run rate on the current debt? Is it a fair assumption in the next couple of next 3, 4, 5 quarters?
You are talking about GPL debt, or you're talking about GAL debt? I'm a little confused with your...
I'm just putting 2 plus 2 together. I'm asking, saying that GMR Enterprises does structured debt transaction. My question is, how does it help us, right? As they
So let me answer that first. As you are aware, GPL is a promoter entity. This promoter entity had taken certain loans from financiers, from financing companies, by pledging its shares in the GMR Airport shares, and use those for business purposes, for investment purposes. These loans were from more than 15, 18 or different finance companies, and these loans also carried cash coupon, and they were always in a mode of some refinancing and some settlement happening all during the year. What this transaction allows is the access to not to a short-term financing, but a very long-term financing. It's an 8-year financing that is there in place. And the pledges that were given in the earlier loans, this particular facility reduces those pledges substantially or significantly. And third is the fact that there is no cash coupon servicing in the interim over the 8 years. And hence, it is only a settlement to be done at a later point of time, and hence there is no pressure on the promoters to finance to service that debt. So basically, it truly matches the purpose for which the loan had been taken through this financing, and removes this overhang of high pledges on the GMR Airport shares. That was always a concern for investors in the capital markets. It permanently reduces that overhang. I hope I've been able to answer that.
Understood, sir. That's very helpful, sir. So my last question is on the interest cost higher side. I understand that, of course, you have refinanced the Delhi Airport loan, but there is also a large amount of loan which is on the GAL, right? GAL level, right? Of 48 billion. Is there any plan to refinance the debt at a lower coupon in the next 3-4 quarters? Can we expect that?
So at every step of the way, our cost on the new financing or the refinancing is only reducing. And here I would like to highlight one aspect. As many of the adjacent businesses have now moved to GAL or GMR Airports, this entity is no longer a holding company, but has now become an operating company. And with the operational cash flows, for example, from duty-free business or cargo business and other businesses, we expect that in the next round of refinancing, the costs of that refinancing will be substantially lower than the current cost, because it's an operating company and there's significant free cash that gets generated by these businesses. So, yes, to answer your question, will there be a compression in the interest costs as we go forward at GAL level? The answer is emphatic yes.
Understood, sir. Thank you and all the best, sir. Thank you.
Thank you. The next question is from Aditya Mongia from Kotak Securities. Please go ahead.
Good afternoon, everyone. Thank you for the opportunity and congratulations on a fairly healthy set of results. I had a few questions from my side. The first one being linked to the question just asked. This is related to when does the peaking out of standalone debt for GMR Airports happen? I understand that there will be new business lines that come about, and then also be refinancing of debt. In your assessment, how far away are we from coming to, let's say, a peaking out of debt happening at the standalone level?
So Aditya, we are very close to peaking out. As you know, that we have already announced the acquisition of a 10% stake in Delhi Airports held by Fraport. That will be financed through debt. So currently our debt is about 5,000 crores. Another 1,000 crores will get added to it. So let's say 6,000 crores. So I would say that would be a peak level of debt at GMR Airports. And during this period of time, cash flows are also started to generate from the adjacent businesses that have moved to GMR Airports. So I would say if you were to combine few things together, if you were to combine dividend flows from the assets, especially from Hyderabad, cash flows coming from these asset-light non-aero businesses, which GMR Airports is now currently doing, fees that the GMR Airport earns from the airports for the management, and some of the receivables that are already there that GMR Airport has to receive, I'm very, very confident that in the next 3 to 5 years, actually this debt will come down to zero. So that is what we are working towards. This particular debt no longer carries a credit risk of a high nature. It's a low credit risk debt that is there.
Understood. Thanks for the color. The second question I had was more on the Supreme Court hearings that are happening as regards to TDSAT's kind of supportive orders for the aero tariff of Delhi. I believe a hearing would have happened yesterday. A, could you give us a sense of how this case is kind of proceeding? When do we expect a final judgment? And B, will the eventual tariff order that comes from ERA only happen and be dependent on the result of this kind of petition, or are both of these fairly different events in themselves?
Aditya, this is basically on CP2, CP3, where Delhi Airport has got a favorable order from the TDSAT. It has been challenged before Supreme Court by the ERA and other contestants. So the hearing has started yesterday, and it may take some more time. And most probably Supreme Court gives only 3-4 days for all the contestants to argue and close the case unless they ask for more time. So we are keeping our fingers crossed. That is one aspect of Supreme Court. The second side is, as far as the regulator is concerned, we have filed in our application even requesting for the CP2, CP3 benefits from the TDSAT. But since the regulator, since the matter has been contested before Supreme Court, how the regulator is going to view it, we are not very clear, but most probably they may not consider unless there is a favorable order from the Supreme Court. So, for this consultation paper, which is likely to come up, the CP2, CP3 benefits may not be included. However, our claim of the Supreme Court earlier order on corporate taxes that we are entitled to, and the entire capex of 12,000 crores which we have incurred, both will be considered by the regulator for the purpose of tariff determination, plus also our future operational capex and everything. So that is what we are considering right now.
Understood. And just to close this topic out, now that we are kind of moving towards a scenario wherein the variables and the quantum of benefit is broadly known, which is of the corporate tax and the capex, would 400 to 450 rupees be an adequate range for the aero yield per pax for the next 5 years, or do you think there are significant upside and downside risks to this number? And I'm assuming TDSAT numbers only reflect in the next control period, not in this one. I'm just trying to focus on the corporate tax and the capex.
Currently, you are right. Currently, our yield per passenger is about 152 rupees. Considering there's so much of huge capex which has not been given any benefit in the last control period, we can assume between 4 to 450 rupees.
And with potential upsides from there on.
Absolutely. I completely agree. Now, the next few questions from my side are linked to Goa. One thing we want to kind of congratulate Goa non-aero revenues per pax are moving quite swiftly towards Hyderabad levels. I wanted to get a sense of where do you think things are going to stabilize. Today, I think that non-aero per pax number is closer to about 170 rupees or so. This was 140 rupees not so long back. Hyderabad is at whatever level it is at today, which is about 210 or so. How do you see the trajectory of the Goa non-aero revenue per pax kind of moving from here on?
Rajesh, you want to take it?
Yes, sir, I'll take this, sir. So, no, I think you're right, Aditya. The trajectory what you are seeing as the business is stabilizing in Goa, both in terms of the traffic, now the coming quarter, you will see more of international traffic is again increasing. So what we can expect is the Goa's spend per pax and the non-aero income should move more or less like Hyderabad and be going forward like Delhi. Very difficult to say what the number would be, but yes, it is in the same direction one can expect. And what we have seen so far, spend per pax both for retail and F&B in Goa is better than being a tourist airport, is better than a couple of our other airports.
Understood. That clarifies. Just the last question, then we can get inside the queue. Again, linked to Goa only. From our perspective of things, there was a 3-year period wherein the revenue share was exempted from. It seemed that that period would have ended somewhere in FY25. Am I right or wrong in this judgment? Could you give us a sense of when does the revenue share start hitting the Goa airport, at what point of time?
Aditya, it is not 3 years, it is 2 years revenue holiday. Since we have started operation and the Prime Minister inaugurated on 2022, 7th December. So 7th December 2024, the revenue holiday period ends, and the revenue share will start kicking from 8th of December. So we will be seeing the next quarter financials for the 23 days. There will be a revenue share that is payable on 7th January 2025. So it is payable on month-on-month basis.
Well, thank you for the color. I'll get back into the queue. Thank you.
Thank you. Next question is from Karthik from Unifi Capital. Please go ahead.
Yeah. Good afternoon, sir. Wish you a very happy Diwali before I shoot up the question. So we just wanted to understand with respect to the orders that Delhi High Court has stood with us in terms of how much would be the retrospective impact if at all we had to recompute the revenue and we had to get an excess refund from June 2015. What would be the tentative number?
It will be very difficult to guess and give the numbers, Karthik. It is basically from 21st June 2015 onwards, it has to be calculated. And as per the order of the tribunal, the Airport Authority of India has to appoint an independent auditor who shall calculate the numbers. So it will be very difficult to provide any bench.
Yeah, I mean, it's easy to calculate it, but it will be too speculative for us to guide you on that. Let the things roll. In the course of time, we'll come to know. But it is a significant number and upside that would be available.
Sure. I get it. So, and just on the credit rating of the airport entity, the listed company, when do we expect to initiate a credit rating upgrade, or now that the Kuwait KA issue is done? So when do we expect a rating upgrade with the listed company?
At the listco, the rating, I think we'll wait for another few months for the rating agencies to see the stable cash flows emanate from the other adjacent businesses that are there. And also, once GMR Airports takes over the operations of Delhi Duty Free, I think it will be a two-step process, but clearly the indications are on the positive side, on the upside of it. So I would still say let's wait for another between 3 to 6 months.
There's no 2 quarters to wait.
2 quarters. Got it. And lastly, on this one, the revenue. So we have now independent revenues, as you specified, that the listed company has become an operational company by itself. But when do we expect the dividend flows from Hyderabad and Delhi airport to flow into the holding company?
Hyderabad Airport, we are hopefully targeting this year it should be able to declare the dividend because it has to comply with the bond covenant, so which will be able to comply most probably third quarter of the financial year. We may look for some dividend payout in the fourth quarter. That's what we are expecting. Delhi, it will take another minimum 2 to 3 years.
Sure. So that's it from my side. Thank you so much. Sure.
Yeah, just as a disclaimer over here, because Hyderabad Airport also has the government as a partner, as a shareholder, and so any dividend declaration is a prerogative of the board. From a financials and cash flow perspective, it is ready, but subject to any regulatory or board approvals there. Just want to highlight that.
Thank you. Before we take the next question, a reminder to participants that you may press star and 1 to join the question queue. The next question is from Shrey Gandhi from CR Kothari Stock Broking. Please go ahead.
Good afternoon, sir, and thank you for the opportunity. My question is regarding the Delhi Airport tariff hike. So if you could quantify like how much tariff hike we are expecting and what benefit can we expect as an entity out of it?
Sorry, can you repeat the question?
I think what GRK Garu earlier highlighted is that the current, the expected tariff should be between 400 to 450 rupees as we go forward for yield per passenger. That is what he had alluded to, but still early days. The process is underway.
This is from our side, but regulator will take his own call. Correct.
Okay, and when can we expect this to be implemented and commissioned?
This is what I had explained, that we are expecting by end of November the consultation paper, and then there will be a stakeholder consultation. After that, the regulator may finalize and issue the final tariff order by mid of February, and hopefully it will be implemented by 1st of April 2025. That is what our estimate as of today.
Okay, thank you, sir.
Thank you. The next question is from Aditya Mongia from Kotak Securities. Please go ahead.
Thank you for the follow-up opportunity. Just wanted to get a better sense of where the MRO EBITDA is as a contribution today, and how to think through the story from the next 3 to 5 years. I think I understand this number today may be less than 50 crores of EBITDA, let's say on a quarterly basis. But how to think through these numbers? When does this start becoming significant in the overall consolidated EBITDA of the company?
See, as far as MRO is concerned, this quarter exceptionally they have done very well, and especially 6 months, they have achieved the last year turnover of 275 crores, and they have touched almost EBITDA of 140 crores, 150 crore rupees. So that may not continue because this half year, because of the Go Air lessors and some other lessors, they wanted to take over the aircraft, they want to take out from India. So all those aircraft have come for special C checks and D checks. But going forward, we are expecting that MRO will continue to grow. This year we are expecting it should touch about 400 to 450 crore turnover. And that will be stabilized around 400 and keep growing around 10 to 12%. That is what our estimation. And it will provide EBITDA of almost 100 to 140 crores on overall basis. And coming to GAL, as a standalone entity, it started generating good amount of EBITDA. We have already generated around 300 to 350 crore rupees for 6 months. For the whole year estimation is about 350 crore EBITDA will generate. So that will keep growing as and when we are adding the duty free and Hyderabad duty free and Delhi duty free businesses, plus cargo and F&B businesses. That you will see a major jump in EBITDA in GMR Airports Limited at standalone level by 2026-27, which should, in all probability, surpass around 1,000 crores.
Understood. I think that was the only question for me. Thank you for the color. That will be all from my side.
Thank you. Next question is from Prateek Kumar from Jefferies. Please go ahead.
Yeah, sir, thanks for the opportunity again. My question is on Nagpur Airport. As you have talked about, like, taking the capacity to 4 million and to 30 million in long term, what is the kind of CapEx which you're looking at, maybe next 12 months, or how should we think about CapEx over medium term in that asset?
Yes, sir, right now we are in the process of completing the CPs, so the time is available is up to 8th April 2025. Thereafter, we'll take over. As far as the concession agreement itself says, the capex will be over a period of 4 years. Starting capex, it will be completed over a period of 8 years. So we are not seeing any substantial capex in the initial years.
Okay. And how is the profitability and tariffs currently at that airport? The aeronautical
tariffs have already been fixed in case of Nagpur Airport, which is not a major airport under ERA Act. So MoCA has already given the tariffs, which are now under implementation. So that is a good amount of yield they have given. So that are valid for a period of 3 years. So we continue to operate with these new tariffs, which MoCA has already given for the next 3 years. Thereafter, if we cross the 3 million traffic, then we'll move into the ERA. So we are likely to get into the ERA regime after 3 years, once this tariff period is over.
And once you start operating this airport, the revenue share of 15% fixed starts, or that is also
Day one it will kick, sir. The moment we'll take over and start operating it, it will kick the revenue share, that is 14.49%. That will continue to, soon after we take over, we have to pay every month.
And you can also develop like non-aero facilities at the airport for the growth in that segment.
Absolutely. The actual requirement is that we have to refurbish the existing terminal, which is about 19,000 square meters. Plus, we have to build a new terminal for 4.4 million capacity. That is the immediate requirement. And thereafter, only the runway and the ATC tower, which has to be completed over a period of 8 years. That is the reason why I said that there may not be any major capex in the next 2 years minimum.
So thank you. This was my question, and all the best.
Thank you.
Thank you. The next question is from Karthik Chellappa from Indus Capital Advisors. Please go ahead.
Yeah, thank you, sir. Just one follow-up from me. Would you have any guidance for the actual CapEx spending for this year and next year?
No, as far as the Delhi and Hyderabad is concerned, the major capex is completed. There will be some operational capex when every year we incur about 2 to 3 billion, that's all, of each airport. Beyond that, there is no capex. Bhogapuram, now under construction, so that will, we have already spent about 800 crore rupees till now, and we expect that by end of this year, we may spend another 800 crore rupees.
So next year, the capex, you have just highlighted that it will be down significantly. So is there any capex budgeted number for FY26, or is that a bit too early?
No, it's too early, sir. The only point what I'm trying to say is Delhi and Hyderabad, there is no capex, expansion capex is completed fully. There will be operational capex, which normally they incur about 150 to 200 crore rupees every year. That is a normal operational capex. Other than that, only Bhogapuram, which is the expansion, which is the new greenfield airport we are constructing, we have already spent more than 800 crore rupees, and we are likely to spend another 800 to 1,000 crore rupees by end of this financial year, FY25. Because FY26 and FY27 is going to start operations. The entire project cost of Bhogapuram itself is about 4,500 crores, so it will be spent over a period of 3 years.
So Karthik, the only airport live from a capex perspective is Bhogapuram, as GRK has said. The rest is all smaller operational capex at Delhi and Hyderabad airport. That's the summary.
Okay. This is very useful, sir. That's all from my side. Thank you very much.
Thank you.
Thank you very much. That was the last question. I would now like to hand the conference back to Mr. Saurabh Chawla for any closing comments.
Thank you. Thank you, everybody, for participating in our quarter 2 call. Appreciate your time. We are available offline to answer any further queries you may have. So Amit Jain and his team are available. So please reach out and all the very best to you. Happy Diwali to every one of you. And let's hope to catch up soon. Thank you so much. Bye-bye.
Thank you very much. On behalf of GMR Airports Limited, that concludes this conference. Thank you for joining us, ladies and gentlemen. You may now disconnect your lines.